Welcome to the Stock Market Palantir. Today we are going to talk about GME, GameStop Corp. As of late November 2025 it remains, it's arguably the most idiosyncratic anomaly in modern financial markets. We're looking at a stock price that's just hovering around $21, maybe $22, that sits right at this weird intersection of retail investor psychology and some really entrenched market structure mechanics. So the central question we have to tackle is, I think, critical. Does this $21 price, does it accurately reflect the fundamental safety from its, massive $6.4 billion cash reserve? Or is the price just an artificially suppressed anomaly? Something caused by profound systemic failures and, frankly, aggressive short-side dominance. My position is, it's pretty clear. GME is fundamentally safe, and I think it's technically primed for systemic market shock based on verifiable failures that you can't ignore them forever.
And I come at it from a bit of a different angle. While I'll acknowledge the structural issues you're citing, and look, they are significant, I won't deny that, I would argue that GME's visible price action is structurally managed. It's almost completely detached from the core business. The stability of that $21 price, despite all this noise, it really suggests that institutional control over price discovery is still paramount. The stock is relying, I think, pretty heavily on these unsustainable sociological factors while being systematically suppressed by market mechanisms that they absorb all that retail buying pressure before it can ever lift the price on the lit exchange.
Okay, let's start with the financials then, because they established the floor. And it's a very, very high floor, I might add. GameStop has effectively transitioned from being just a struggling retailer to what is, it's essentially a holding company, or at least a cash-rich investment vehicle. The balance sheet is a fortress, $6.4 billion in unrestricted cash and zero long-term debt. I mean, that is just immense financial security. To really grasp the valuation, you have to look at the enterprise value, the EV. So you take the $10.1 billion market cap and you just subtract that $6.4 billion in cash. That leaves an enterprise value of only $3.7 billion. That means the market is valuing the entire operating business, the brand, the stores, everything, at just $3.7 billion. That's a massive, almost unheard of margin of safety for a company with this kind of brand recognition.
That's a compelling argument about the cash floor. And I can't dispute the $6.4 billion sitting there, but the persistent price suppression, it suggests we have to focus on the broken mechanism of price discovery itself. If there's such a massive margin of safety, why is the price trended down or sideways? I mean, it's down about 12% in November 2025 alone. The core issue, I think, is dark pool internalization. This is a structural anomaly where up to 60%, sometimes more, of the trading volume, we saw it hit 66.3% on November 20th, is routed entirely off exchange.
Right. Okay, so break that down for our listeners. Why does trading off exchange matter so much?
It matters because that's how the visible price stays pinned. When all these aggressive retail buy orders come in, often in what they call odd lots, so orders less than 100 shares, wholesalers step in. They use mechanisms to legally sell short from their own inventory to fill those orders, and they absorb the buying pressure immediately. This systematic absorption, it prevents retail demand from ever actually hitting the public lit exchanges like the NYSE. So that 2174 price we see, it's determined only by the residual volume that actually makes it to the order book. And crucially, that $6.4 billion in cash, while it's a great safety net, is currently stagnant. Management hasn't deployed it. That inaction frustrates investors, and it gives the algorithms free rein to just pin the stock until a capital allocation decision is finally made.
I see why you emphasize the management of price, I do. But let me give you a different perspective, one that's rooted in settlement failure, because while the dark pools can manage the flow, they can't entirely erase the liability. We have to return to the severity of the fails to deliver the FTDs.
The 32 million fails in late November? I mean, yeah, that's certainly a staggering number.
It is. A fail to deliver happens when one party in a trade just can't deliver the shares they sold by the settlement date. And we saw FTDs spike to over 32 million shares late last month. To put that in perspective, that single FTD obligation was nearly 600% of the average daily trading volume. And this spike, it coincided precisely with the aftermath of the warrant dividend complication back in October, which trapped short sellers who suddenly had to deliver both the stock and the newly issued warrants.
And what does that mean in terms of a mandatory closing?
It means the settlement plumbing is catastrophically broken, creating a massive required buy-in if the rules are actually enforced. Regulation SHO, Rule 204. These are explicit mandates from the SEC. Rule 204 says these fails must be closed out by purchasing securities in the open market within 13 settlement days. If that's strictly enforced, this demand, which is 6 times the daily volume, it just mathematically overwhelms supply. This should, by all accounts, guarantee a potential melt-up. The mechanics demand it.
I'm sorry, but I just don't buy that the forced buy-in is inevitable, not in the short term. Because if it were, the price would already be reflecting that violent demand. The fact that those 32 million FTDs have persisted over multiple reporting periods, it indicates that the market is currently pricing in the risk that these FTDs will be kicked down the road. Institutional players have proven they have mechanisms to defer this kind of systemic risk. We've seen it before with things like ex-clearing transfers or even operational shorting within ETFs, which can mask or just perpetually delay the requirement to find those shares.
So are you suggesting they're simply violating Rule 204? Or just finding very clever loopholes?
I'm suggesting they are managing risk through complexity. The sheer magnitude of the fail, yes, it suggests an institutional inability to close, but it equally demonstrates an institutional ability to manage or defer the systemic consequences without immediate price impact. This is where your thesis on timing kind of breaks down. The potential buy-in is a latent threat, not an immediate one. Until a regulator or a clearinghouse forces the issue, the pressure is contained.
Okay, but that brings us to another element of complexity that I think actually acts as a weapon against the short thesis. The warrant dividend, GMEWS. You might see it as just a dilutive threat, but I view it as a volatility multiplier.
Oh, I agree it's complex, but let's be realistic about the structure. The warrant has a strike price of $32. There are 59 million new shares attached to this. This structure, it acts primarily as a psychological ceiling, a dilution fear. Traders are inherently hesitant to bid the price far above, say, $25 or $28 because they know the company has the option to call those warrants. If the stock price surges past 32, the company is incentivized to call them, triggering the issuance of 59 million new shares. That future supply acts as a concrete cap on upward momentum. It tells the market there is massive incoming supply if the price gets too high.
That's an interesting point on supply, though. I would frame the psychological impact differently. I see the warrant as a sophisticated complexity bomb, and frankly, a fantastic capital-on-demand vehicle for the company. First, just consider the market price of the warrant itself, which is trading at a significant premium, around $3 to $3.50. That premium suggests the market expects significant volatility and a high probability of the stock hitting or exceeding $32 well before expiration in 2026. A $3.50 price on that warrant implies a major expected move.
But the risk remains defined by that 59 million potential share issuance.
Yes, but it compounds the short problem geometrically. Short sellers who are caught by this are now obligated to manage exposure to 2 highly volatile securities, the common stock and the warrant. So if retail investors who saw this as a strategic move decide to hoard the low-float GMEWS, it creates the risk of a secondary and potentially more violent warrant squeeze. That could inflict massive losses on shorts, even if the common stock stays managed in that kite $20 to $23 range. It's an asymmetric risk profile designed to just bleed the shorts.
We can't ignore the sociology here, though, which is maybe the most unique aspect of this whole situation. The retail base is acting as an economic actor whose motivation goes beyond simple profit.
Absolutely. I view the retail base as a kind of decentralized hedge fund. Their technical sophistication is undeniable. I mean, take the purple circle DRS movement. This is where investors move shares out of the DTCC and directly into their own name. This action actively locks away liquidity by removing shares from the tradable float. So the remaining float becomes exponentially more susceptible to those volatility shocks we talked about.
And what about this heat lamp theory? I keep hearing that term.
Right, that's a key piece of evidence of their sophistication. It's this idea that you should convert your plan shares to strict book shares within the transfer agent. The theory is that plan shares are still partially accessible to the DTCC for operational purposes, whereas book shares are truly completely immobilized. Their understanding of market plumbing is incredibly detailed, and this deep value thesis is reinforced by the earliest analysis from people like Keith Gill and his current silent confidence. I mean, he's shown a position of over $180 million. That's serious institutional level commitment.
I concede that the retail base is highly informed. They are ideologically driven, far beyond any retail movement we've seen before. But their collective action is being rendered practically ineffective by algorithmic control. If their goal is to cause a liquidity shock through DRS, why does the chart exhibit such persistent barcoding and unnatural stability?
Barcoding?
Yeah, that tight, predictable trading range. Within that $20 to $23 band, it supports the theory that high-frequency trading algorithms are actively managing the price. They are essentially creating this synthetic stable environment to keep the institutional risk contained and, crucially, to bore retail investors into selling because there's no volatility. This neutralization tactic is highly effective. You have the buying power, the intent, and the technical knowledge on the retail side, but the price discovery mechanism is designed to just systematically bypass and demoralize them.
So we're left with this stark divergence. On one side, a company with a massive $6.4 billion safety net facing a technical settlement failure of 32 million shares that mathematically dictates a buy-in. On the other, an infrastructure designed to absorb and neutralize that pressure.
Precisely. The question is whether the sheer weight of technical liability will eventually overwhelm the institutional ability to just keep deferring the risk.
Well, I maintain that the technical data, the 32 million FTDs, compounded by the warrant risk and underwritten by that cash-rich balance sheet, it presents a scenario where the current price is not a reflection of risk, but rather the calm before a settlement-driven storm. The siege continues, backed by the company's strongest financial position in its history.
And I agree, the anomalies are real and serious. But the structural dominance of off-exchange trading suggests institutional control over price discovery remains paramount. The FTDs are a massive, latent threat. But until that $6.4 billion war chest is deployed, or until regulatory enforcement finally forces the closure of that obligation, the stock remains a profound financial paradox.
The GME story, it certainly continues to illuminate structural weaknesses and complex forces within our modern equity market that require a lot of continued scrutiny.
It really highlights the tension between traditional financial regulation and this new era of decentralized investor power.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.